Chapter 16 is about corporate operations. So, let me see here. Well, this is, I know it's cutting off a little bit at the bottom here. You're missing a line, so you might want to look, if you're following along here, look at the slides or the PDF of the slides that is in Canvas, so you can see anything that gets cut off, because sometimes my screen capture doesn't capture the whole screen. Anyway, this is just a look at the general calculation for corporate income tax. We talked about the different characteristics last class or last chapter of some of the business organizational structures. So obviously we're talking specifically about C Corps here when we talk about the corporate tax formula, and you can see it just compared or juxtaposed against the individual tax formula next to it there. Okay. So you've probably talked about this, and I know if you've had me in other classes, in intermediate and others, we've talked about this, but so especially for any companies that are using GAAP accounting, so any of your big Fortune 500, publicly traded companies, anything like that, they're going to have to be keeping two separate books. You're going to have to be keeping track of things for your tax purposes, and you're going to have to be keeping track of things for your GAAP accounting reporting purposes. So what that creates is some differences. So if you're using different rules to do your accounting in these two different scenarios or with these two different sets of books, then obviously some of the numbers are going to be different. But to make sure that those differences are allowable in both areas generally, in the GAAP accounting financial statements, and also with corporate tax filing and just keeping track in your records, you would keep track and reconcile taxable income to financial income, or vice versa. So typically what you do is you start, typically on a day-to-day basis, track things GAAP-wise, and then you go from those GAAP numbers, so your financial net income numbers, and you'll reconcile that to taxable income. So basically, that would allow you to look at your two sets of books and say, okay, are these matching up? It's essentially like looking at the balance sheet and making sure that it balances. That's essentially what you're doing here. Now, that last bullet point is just saying, hey, if it's not a GAAP required company, then what they might do is just keep track of all of their books using tax required, using the regulations required under tax law, and that way they don't have to keep track of two sets of books. Since we're talking generally, when we talk about corporations, C Corps anyway, we're generally talking about bigger companies, so we'll just assume for discussion purposes in class that we're talking about these bigger companies, so they will have to have two sets of books. So unfavorable adjustments just mean you have to add these to book income to get to taxable income. So in other words, these are things that are going to make your taxable income greater than your book income. Favorable would be the other way around. And any differences are either going to be permanent or temporary. So permanent differences obviously will never reconcile on their own, and you're always going to have a note that shows why they're different. And temporary differences just mean, hey, one standard is telling me to recognize this income or expense or whatever in this time period, whereas under the other set of rules, it's saying to recognize this in a different time period. And so while things look different for now, they will eventually meet back together when both of those time periods have elapsed. This is just a look at some of the common book tax differences, some of those being temporary, and again, some of those being permanent. I guess all of these are temporary. And then, let's see, maybe I already skipped over the permanent ones. Oh, here we go. Some of these are permanent, some of them are temporary. When we talk about net capital losses for a corporation, these are just some of the characteristics of that, and you'll see that some of those are different than net operating losses if you're talking about an individual who's receiving income either through a pass-through entity like a partnership or an LLC, or is operating a sole proprietorship where they're basically just using individual tax laws. So no current deduction for net capital losses. So basically once you hit 0 there, you can't go any further. It doesn't help you any more in that tax year, and doesn't help you in your non-capital income area to have capital losses this year. You can carry them back 3 years and forward 5. And that sub-bullet point there is just saying, hey, as you're tracking these capital losses, you'll use up any ones you're carrying over. You'll use up the older ones first, and that way you basically will get to use the carryovers for as long as is possible. Let's see here. No current benefit from current year operating loss, and net operating losses can go back 2 years and forward 20. So difference between this slide and this one, capital versus operating. So again, operating is what your normal day-to-day business type stuff is, and capital is going to be anything that is considered a capital asset that you're losing money on or gaining money on. Okay, when we talk about charitable contributions, this again is going to function differently than as an individual. For the amount of the deduction, you're typically going to talk about any gain property. So this is would be anything that would fall typically in that capital gain section. Would be that you donate to a charitable organization. Would be the value would be the fair market value. And anything that is in your ordinary operations, which is considered income property, you would use the adjusted basis for that if you donated an income property. Now you see this is different than the 50% threshold for individuals. You're limited to only 10%, and that 10% has to be figured. Well, I guess this is a benefit to you, so I shouldn't say it like that. That 10% is figured before you take out any of these other things. So that gives you, if you had taken all these things out first and then took 10% of that, then that would give you an overall less or lower limit for your deduction. So that does actually help you a little bit. And you can, anything above and beyond that 10% that you donated this year, for whatever reason, you can carry forward to future years, again with the stipulation that in any 1 year, the amount that you deduct cannot be greater than 10% of taxable income before deducting these items. We talked about this one, I think, maybe last week, but I know we talked about it. We might have talked about it in intermediate, so I take that back. If you are not in my intermediate class, then we did not talk about this recently. Anyway, this is what allows a corporation who invests in another corporation to not be taxed 3 times if they receive dividends from the corporation they've invested in. I know that's a little bit confusing, and really, advanced accounting is where this comes up more than anything, and is talked about more there. But you should at least know these are the ownership thresholds, and depending on how much the corporation owns of the other corporation, whether it be lower than 20, between 20 and 80%, or more than 80%, that will determine whether 70% of the dividends received from that underlying corporation are deductible, 80%, or a full 100%. When we're talking about just the regular tax rates for a corporation, the marginal rates, which again, marginal rates just mean with our graduated tax system, how much are you going to pay on the next dollar of income that you're figuring. So it starts out low and then goes up from there. And you see the rates from 15 to 39%. Well, once you hit a certain, and it changes year to year, but once you hit a certain threshold of income, it just becomes overall, you still go through all of the graduated rates where you're saying, well, up to, I don't remember the exact rates, but up to like $50,000 in income, it's a 15% rate. And then on all your income from $50,000 to $250,000, it's 20%. And then on all your income from $250,001 to $2 million, it's this next rate up. So that's what I mean by a graduated system. And that's what individual and corporate is for the United States. And you see that 39% there. That doesn't mean that anyone's overall rate is 39%. Because once you go all the way through the graduated rates, the next dollar of income that you earn is taxed at a 34 or 35% rate. And depending on whatever one of those you fall into, once you hit that rate, it means that overall your total rate is at that rate as well. So if you average all of those marginal rates out, assuming you have to pay at each level all the way up, that averages out to 35%. I'm not going to talk too much about controlled groups. We talked about that a little bit as well. These are the forms that you have to fill out, and here's a look at what those look like. And we'll probably look more in depth before the end of the year and maybe go through a few of these as well. This is the reconciliation of book to tax income. We'll look at all of these 1120s, M1, M3s. You just saw there the book tax adjustment or book tax reconciliation form. Due date for taxes is 3.5 months after the close of the tax year. So again, that's going to depend on when the corporate tax year, the fiscal year ends. And consolidated tax returns are just what you have to file when you're a consolidated entity. In other words, you're a parent corporation who owns a bunch of subsidiaries. That's the estimated payment schedule. Corporations are required to pay estimated payments, basically if they're making any money at all. And if you don't make those payments, that's essentially like missing your tax deadline. So you could be fined for late payments above and beyond, or for anything less than the required amount that you've paid. Same thing here for required annual payments. Alternative minimum tax is very similar to individual alternative minimum tax, where you're basically adding back in or taking out some other, adding back in some components of your income that were not taxable for whatever reason in order to make sure that you're not paying too little tax. So basically, you add back in all of these categories. If you qualify for this exemption, you add that back in, and basically that's just if you're a small corporation. And that gives you your base. Multiply that times 20%. That gives you your gross AMT, which unless you're a foreign corporation is also your tentative minimum tax. And then anything you've already paid in income tax is subtracted out, and that leaves your alternative minimum tax. Now, if your tentative minimum tax is less than what you've already paid, then you have essentially a credit built up, and you can use that to offset any future alternative minimum tax that you would have to pay. Let's see here. That's basically just looking at what these adjustments are. You don't have to know what they are. You can just look at this. This chart will get you most of the way to where you need to be in calculating whether you need to pay alternative minimum tax or not. I mentioned the exemption. It's $40,000 if you get all of it. Once you hit the $150,000 in alternative minimum taxable income, you start to phase that out, and it's basically proportionately phased out until you get up to 310. And then that part I was talking about at the end, if you don't owe alternative minimum tax, whatever the difference is between the AMT and what you paid creates a credit, and that carries forward indefinitely. And that's the end of the slideshow. So again, not a horribly painful chapter in tax, but it is the basis for what we'll talk about for the rest of the year.